As it stands here today, it appears we've hit a local bottom in Bitcoin down at the $75,000 range, and we've recovered from that, and now we're bumping up against some serious resistance at the $88,000-$90,000 level, and we've got to kind of break through that mentally and hold that for this to stand. But I think that Bitcoin's catching a wave like similar to gold, where you've got investors who are putting money in both gold and Bitcoin, and that the U.S. dollar being weaker is making Bitcoin stronger as well. And so it's a long way of saying that the decoupling, I appreciate it, I like it, I want to see it continue, and we're going to have to see weeks and months of this for it to really hold. The divergence from Bitcoin and risk on assets like the NASDAQ and regular stocks, at the same time that bond yields are going down. Actually, I'm sorry, the bond yields are going up, so bonds are going down. So you would think that the flight of safety would be to bonds. And for people who are new to this whole game, when you buy bonds, you're buying them at above or below par, right? And if you buy it below par, that means you're buying it at a discount, which means that the interest rate you're effectively paid, because you're getting paid coupons on these things. Those coupons are set. So if you paid less for the bond, then that coupon becomes just a larger percentage. And so that's why yields go up when bonds go down. And that's kind of the way it works, right? So, but you would think stocks going down, well, then bond yields would probably be going down too, because bonds would be going up, because that money would be flowing into safety assets like the risk-free asset, which is the U.S. Treasury. Not really risk-free. We know that. We talk about that all the time, but that's the quote on Wall Street. Risk-free is the U.S. Treasury. It's not. It's not risk-free. We learned that the hard way during the pandemic, when we way overprinted money. Not we, the central bank, the Fed, way overprinted money, caused massive inflation from the expansion of the money supply, massive asset inflation, massive inflation across financial assets. And because we're so financialized as a nation, everything went up in price, along with supply issues and supply chain issues and bottlenecks and all that. But that was kind of a goat that should have gone through the boa and gotten out the other side. It never did. And we had these this crazy inflation for years and years because of the expansion of the money supply. Let's just call it what it is. So you saw bond yields. What happened was bond yields spiked because Fed funds went up, and bond yields went up in order to compensate investors for that high inflation. So if you're a bond trader, you're not going to buy a 10-year treasury at 2% if inflation's at 5%. You want to be compensated for that. And so when that interest rate goes up, the bond price goes down, and all these banks, all these community banks that were holding these treasuries got absolutely annihilated. And that's ultimately what caused the collapse of Silicon Valley Bank 2 years ago. And that's kind of, if people remember back, well, that's not risk-free to me. That sounds risky to me. It's risk-free in the sense that, yeah, if you hold it to maturity, it's a non-zero probability that the U.S. will hard default on that. But it's about as close to zero as you can think of, because the U.S. Treasury has the ability to team up with the Fed and print money to buy its own bonds. So of course they're not going to default. They're just going to print money and make sure that these things are always trading. And so, that's it's called a soft default. And that soft default is inflation through expansion of the money supply, which is debasing the U.S. currency every single day in order to keep this whole debt charade going. And that's kind of the point, right? Big picture, what's been happening? Well, Trump has threatened to enforce these tariffs on all these countries, and big tariffs. And so that has caused quite a bit of angst for a number of reasons. There's angst with people who import materials and goods to sell here in the United States. So you getting some misinformation of the actual demand, the underlying demand of the economy, because you've got manufacturers and suppliers who are importing goods in order to get ahead of that tariff. The underlying economy has not been doing that great. There's a lot of negative indicators out there. And so we're just watching these things and seeing if they continue to kind of snowball, especially things like the unemployment rate, now that you've got government jobs coming out and all of that. But so you've got the economy is clearly softening. You've got cross current of information of what are the actual trade numbers, what are the actual purchasing and index and the PPI and all that. Like what's PMI, all like what are all these telling us? And then at the same time, you've got investors who are worried that the earnings of companies are going to get negatively impacted. At the same time, you've got bond investors worried that, well, if we're going to, hammer China with these huge tariffs, they're going to turn around and they're going to shore up their own currency, and they're going to turn around, and the way they do that is by selling treasuries that they have. So if they sell U.S. treasuries, what does that make the treasury do? It goes down in price and yields go up, something we may be seeing here, right? And so, or it could be traders getting ahead of that, worried about that scenario where China starts selling bonds, and not just China, other countries too, selling U.S. treasuries in order to get dollars to sell those dollars and buy their own currencies. Those are possibilities. You're seeing the dollar go down in value against other currencies across the board here. The DXY is down, and that suggests some of this is happening, or just the confidence in the US dollar, the US Treasury is waning. That's all happening. And then you layer on top of it, Marty, that basis trade I was talking about. And that's kind of like the powder keg that is behind the scenes that the very, very intelligent investors know about. They understand it, and they're watching carefully. They're watching credit spreads. They're watching the spreads of the bonds to the futures, the bond futures, and they're gauging whether or not this trade has is going down the path of blowing up in hedge funds' faces. We're watching all this, and I don't know if these trades are being unwound, but I can tell you that there are hedge funds that are anticipating problems of other hedge funds with them, and so they're getting out of some of these trades, and that's why you're seeing some of the movement in the yields, I believe. And so, but what's happening is, and what's so important about this is that this is to get an idea of how impactful and how explosive this trade is. They had the Brookings Institution. For those of you who don't know what that is, it's a think tank out of DC. And it's basically a tacit research arm of the Fed. I mean, it's a very strong statement, but what I mean by that is that there are a lot of former Fed officials that work at Brookings Institution, and they research and float ideas and policy there to kind of see how they're received, and what people think about it and what the Fed thinks about it. And so for instance, they did, and I've said this before, the Somm rule, the Claudia Somm worked at Brookings Institution. She was a lower Fed official. She worked at Brookings Institution. She came up with something called the Somm rule, which is that unemployment rate rule that to keep the numbers very simple for everybody, basically if the unemployment rate goes up by more than 0.5% from the bottom in a cycle, that means we're in a recession. We've gotten very close to that. But that's a rule that the Fed looks at now. That's something they use as a gauge to say, okay, we're in recession. We've got to lower rates. They haven't seen it yet. It's very close, but that came out of the Brookings Institution.
Is there any feasible way to unwind that trade outside of overt intervention from the Fed?
Not rapidly, not quickly. I mean, it could be catastrophic to the market. Yeah. So you've got it. I would imagine some of these, some of them are unwinding some of it, But I'd also imagine, Marty, that you've got hedge funds who are stepping into it, like they're looking for opportunity. If they see an opportunity they think that they can stomach, they're going to step into it. So it might just be moving from book to book. We don't know. It's hard to tell. And so much of it is on swap. It's hard to tell. We're so financialized, like I was saying, as a country, as an economy. If the stock market blows up, really blows up, we are headed for a deep recession. And the only way we can pull out of that is by printing more money. So what happens to bond yields? Bond yields will go up in that scenario because the bond traders, the vigilantes, are going to want to be compensated for the clear and obvious inflation that's going to come from another expansion of the money supply. And so that's the issue here. So do bond yields go down to 2% because we just slowly grind into a recession here? Or do they spike up to 5-6% because we have blown up the economy and the Fed's turning around and printing money to oblivion to save it? It's a good question. And that's why you're seeing a lot of uncertainty in the market. People don't know where we are on that spectrum. And some of it has to do with, headlines and a tweet, from Trump. He could just tweet something that just spooks the market to the point where, you have the NASDAQ sell off 3 or 4%. Oh, well, look at that. It's down 2.5% today. It was down over 3% earlier, I believe. The telling thing is that bonds are not acting like they should as a flight to safety. That's number one. And number two, gold is absolutely ripping higher, rocketing higher, because it is a flight to safety. And investors are looking for a place to put money to just protect it. And gold has been a strong store of value for centuries. And now we get to the question about Bitcoin. And Bitcoin diverging today is very interesting. It's interesting because is it following gold? Is it finally, are people just realizing, like you said, that arbitrage, is that closing, that understanding arbitrage? Is it just because the dollar is so weak, which means that the dollar Bitcoin price goes up? That's part of it. We were talking this morning on a different show, on the Macro Monday show, and Dave Weisberg brought up a great point that over the weekend, Charles Schwab talked about having a platform to trade crypto. And, I've been talking about this for a number of months now, that SAB 121, the full repeal of that through issuing SAB 122, for those who do not know what I'm talking about, this is where the Fed a couple of years ago did an end zone run around legislation, and they put out this bulletin that basically said that banks had to hold Bitcoin as had to hold Bitcoin and crypto as a liability on their balance sheet, even if it was just on the customer's account. So it basically prevented banks from dealing at all in crypto. And this was kind of an aspect of choke point 2.0, where they just didn't want the banks to be involved. And, you can kind of speculate who would be driving that. But up in DC, it's clear that Elizabeth Warren and her anti-crypto army were a very big part of all this. Because when the Fed did that, and then a number of months later, almost a year later, I think, Congress met, and both Congress and the Senate passed legislation to repeal SAB 121, which is that bulletin. And then it got to Biden's desk, and he vetoed the repeal. And that was clearly he was pushed and advised by that psycho, the psychopath from Massachusetts, Elizabeth Warren, who she has done nothing good for this country, clearly. Just a lot of talk and a lot of, money going into her pockets. Insane. I don't know how Massachusetts keeps voting for that person, but in any case, he was advised by her team and other teams to repeal it, to veto that repeal. Finally, we get Trump come in. Trump comes into the office. Gensler resigns. A new bulletin comes out, SAB 122, that repeals SAB 121 and says that banks can own and hold crypto and Bitcoin for customers without having to put it in as a liability on their balance sheet. And so now that's a very, 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 very big deal. It's a really big deal because you will have banks like Chase and Citigroup and Wells Fargo start dabbling into this space, especially in Bitcoin. And I expect other ones. I expect Ethereum and Solana and other ones, but they're going to start dabbling in these and allowing customers to buy and hold them right there at the bank, which is new. This is huge, because you don't need a brokerage account. You can do it right there. You can do it right to your bank there, and they'll hold it for you. Like, this is going to be a big deal, and I think it's underappreciated just how important it is that banks will now get into this game. And this is part of the first they fight you, right? And then at the end they join you, and here they are. They're right on the cusp of that, and that's a big deal. So that could be part of this too. But I think it's a combination of things, Marty. First of all, I think unless we get another meltdown of the market where everything correlates to one, and that's just reality. The only thing that may not go down in that case is gold, but I think that even gold would, because when everything correlates to one, it means that you're getting margin calls everywhere, and you sell what you can, not what you want to, and so everything ends up going down because you have to get cash to meet margin calls because everybody's levered. So
welcome back to the Market Chronicles. This is episode 17, and we've got another deep dive for you today.
That's right. We're cutting through the noise to give you those essential market insights.
And today, we're really digging into some recent commentary from James Lavish. We've got his analysis right here.
Yeah, looking at his thoughts on, well, quite a bit. Bitcoin, bonds, the dollar.
Potential economic headwinds, too, right?
All right.
This interesting basis trade he mentioned.
Definitely. The goal is to unpack all of that for you, get to the core of what he's seeing in the markets right now.
And hey, if you happen to be watching us on YouTube, do us a favor and hit that subscribe button. It really helps us keep bringing you these analyses.
Okay, so let's start with Bitcoin. Lavish noted sort of local bottom, maybe around 75K.
Yeah, and resistance up near, was it 88 to 90,000?
Right. But the really interesting part, I thought, was his comparison to gold.
You mean as a potential safe haven? Especially with the dollar looking a bit weaker.
Exactly. And the key thing he's looking for, the thing we're all sort of watching, is that decoupling.
Decoupling from risk assets. So Bitcoin moving independently from, say, the NASDAQ, even if bond yields are rising.
Precisely. Rising yields meaning falling bond prices, of course.
Right. Always good to remember that inverse relationship. Newer bonds pay more, so older ones have to drop in price to offer a competitive yield. It seems simple, but it trips people up.
It does. And Lavish points out something odd happening there, too. Usually when stocks fall, people rush to bonds, pushing yields down.
But that's not really happening, is it? Or at least not consistently.
Not in the way you'd expect. Lavish ties the yield spike mainly back to the Fed, hiking rates to fight that post-pandemic inflation.
Which came from all the money supply expansion. Yeah, makes sense.
And those rising yields, well, they weren't just theoretical. They hit the banks holding older treasuries hard.
Silicon Valley Bank being the big example he brought up, the value of their bond holdings just plummeted.
Exactly. Which leads to his point about U.S. treasuries maybe not being totally risk-free anymore.
The soft default idea. That the government might just print money to pay its debts, effectively devaluing the currency and the bond returns through inflation.
It's a serious consideration.
Yeah.
And speaking of risks, he also talked about potential economic headwinds.
The tariffs discussion, right? Trump's proposals.
Yeah. Lavish flagged a few concerns there. One was importers trying to front-run the tariffs, buying stuff early.
Which distorts the demand signals, makes it hard to see the real underlying strength or weakness in the economy.
Right. He suggested there might be weakness hidden behind some of the data.
Yeah.
And that tariffs could really hit company earnings later on.
And for bond investors, the worry is, what? China selling treasuries?
That's the fear. If tariffs provoke countries like China to dump U.S. debt, that pushes treasury prices down and forces yields even higher.
Compounding the problem. He also mentioned the dollar index, the DXY, weakening. Is that related?
Could be. It might reflect those dynamics or just, a general waning confidence in the dollar or U.S. Treasuries. It's all interconnected.
Okay, so let's talk about this basis trade he mentioned. He called it potentially explosive.
Yeah, something known mostly to sophisticated investors. He brought up the Brookings Institution.
Which he described as almost like a research arm for the Fed, right, with former officials involved.
Kind of. He mentioned the SAM rule for spotting recessions came out of Brookings, just as an example of their influence.
So what's the worry with this basis trade? Why is it explosive?
The main concern seems to be unwinding it. If it has to happen quickly, without the Fed managing it carefully, it could be catastrophic.
Like systemic risk, kind of catastrophic?
That seems to be the implication. And he noted that even with the known risks, new funds might still be piling into these trades, so the overall exposure is a bit unclear.
It just highlights how interconnected everything is. He suggested a big stock market drop could mean a deep recession.
Which then probably leads to more money printing.
And potentially higher bond yields again, weirdly, to compensate for the inflation risk from all that printing. It's a loop.
It really is. And while all this is happening, he pointed out gold is, quote, ripping higher.
The classic flight to safety playing out there, at least.
Yes. But Bitcoin's behavior, he called it very interesting. Is it finally acting like gold? Is it just arbitrage becoming more efficient?
Or just the weaker dollar lifting all boats, maybe. Lots of questions there.
Definitely. Which kind of brings us nicely to his points on SAB 122.
Ah, yes, the accounting bulletin. This repeals SAB 121, right? Explain that again.
So SAB 121 basically forced banks, if they held crypto for customers, to list it as a liability on their own balance sheet.
Which is expensive from a capital requirements perspective, right? Discourage them from getting involved.
Massively. Lavish mentioned Congress tried to repeal it, but Biden vetoed, apparently due to anti-crypto pressure.
But now SAB 122 is in effect overturning 121, so the barrier is gone.
Essentially, yes. And Lavish thinks this is huge. It could mean big players, Chase, Citi, Wells Fargo might finally start offering crypto custody, trading.
Directly to their massive customer bases. Wow.
He's framed it as that classic cycle. They fight you, and at the end they join you. He sees it as a major bullish factor for Bitcoin.
Yeah, you can see how that could contribute to some of the recent strength.
Absolutely. It's another big piece on the board.
So, wrapping it all up, the picture Lavish paints is one of, well, significant uncertainty.
Definitely. You've got confusing economic signals, these geopolitical risks like tariffs, and then these complex underlying market structures like the basis trade.
And big questions about where bond yields go next. Is it a slow grind down in a recession, or does inflation spike again from more printing, pushing yields up?
It feels like we're walking a tightrope. And as Lavish implied, sometimes even just a tweak can move markets in this environment.
A key takeaways seem to be, watch the bonds. They aren't acting quite normally as a safe haven. Gold is strong. Bitcoin is interesting.
It's a complex mix, for sure. Understanding these different forces, like the ones Lavish highlighted, is pretty crucial right now.
Absolutely. It really makes you think. So here's something to ponder. Given this backdrop, potential inflation, potential recession, this evolving role for assets like Bitcoin, how are you thinking about navigating this uncertainty?
That's the big question for everyone, isn't it?
It is. Well, thanks for diving deep with us again on the Market Chronicles.
Always good to unpack these things.
And remember, if you're on YouTube, please subscribe for more deep dives like this one. I'll see you next time.